Welcome, I'm Damien Hennessy and this is the third quarter 2024 market update. In this session, we're going to be looking at the key themes and forecasts. First of all, the global easing cycle we believe has begun. The tightening cycle is now behind us. We also believe that US growth is going to slow back to a below trend pace over the course of 24 and into 2025. The disinflation regime that we saw during the course of 2023, we think has re-emerged and is likely to continue over the course of 24 and into early 25, but the progress from here is going to be a lot more difficult. In that environment, the Fed is expected to ease two to three times beginning in September. The RBA is likely to follow, albeit a little bit later, possibly very late this year, but most likely in early 2025. In that sort of environment, there is some scope for a small bond rally, but it is limited. We also feel that the US election result, or US election and the result, carries inflation and interest rate risk with it. And then we'll finish up by looking at our portfolio positions, where we'll run through the reasons why we remain overweight quality, overweight global small caps, investment grade credit, and global equities in preference to domestic equities. So let's just recap what's happened in markets over the June quarter and over the past 12 months. Focusing on the green bars first, this is annual performance in obviously equity markets. The second entry there, this is global equities ex-Australia generating above 20% returns, a very, very strong year, and we'll talk about that in a little bit more detail shortly. A-REITs down towards the bottom, you can see they had a really strong bounce this year, albeit from very, very low base. Across other markets, you'll notice that global small caps, the first line, lagged global equities. EM also lagged developed markets, while the Australian market at the bottom of that chart, green bar, also lagged global equity performances. But pretty much everything has rallied over the past 12 months, including bonds and credit. Over the most recent quarter, you'll notice that global small caps once again underperformed, Aussie small caps and A-REITs, while global equities and emerging markets actually generated positive returns. There's been a lot of discussion around the concentration in the US market, and that can be a bit of a concern. When we look at the concentration, the chart on the left, we can see that the bottom three stocks there, Nvidia, Apple, and Microsoft, comprise 21% of the S&P 500. This is probably the most highly concentrated the US market has been since the 1960s. Of course, they also dominated returns. And you can see on the right-hand side, this is looking at the past 6 months, that Nvidia has contributed more than 10% of the overall 15% return from the S&P 500. And the other AI-related or mega cap stocks have also been key contributors, while the broad market, the other 494 stocks, actually lost ground over the first 6 months. What we can also say, though, is that this has been partly fundamentally based because those stocks and those sectors in which they reside have generated really strong earnings growth. For example, the communications sector, which includes the likes of Meta and Alphabet, EPS is around, or earnings per share growth is around 18%. If you exclude those two stocks, the growth in earnings in communications has been something like 3%. And again, in the IT sector, earnings growth of around about 16%. If we exclude Nvidia, it comes back to about 7%. So the broader US market is expected to have generated about 9% earnings growth over the year to the end of June. But if we exclude the Magnificent Seven, then that earnings number is only just turning positive after being negative for a number of quarters. So it is dominated, the market is dominated by those stocks. They are dominating the earnings picture, and they are also dominating the performance of the market. We're now coming up to earnings season, where we'll get an update as to whether these lofty expectations will actually be met. Let's just broaden this out now in terms of the macro developments over the past quarter or so. The chart on the left-hand side shows the progress on inflation over the past 12 months, where you can see across all regions, maybe with the exception of Japan, but across all the other major economies, inflation has been coming down, no more so than in the UK, which is the darkest line there, where inflation has fallen from 11% to 2%. In EU has fallen to 2.5% from close to 11%. US, as we saw recent data, slowing back to 3%. It was once 9%. Probably the interesting standout there is our own economy, Australian inflation, the yellow line or the gold line, which has seen a bit of a pickup in inflation over the most recent couple of quarters, back to 4%. So Australia's lagging that. Inflation probably peaked a little bit later here, and we're still in this period where there's some doubt as to the trajectory of inflation going forward. On the right-hand side of that table, you'll see growth. The blue line represents growth within the manufacturing sector. And you can see there's been a bit of an improvement in the last 6 months, albeit very modest at this stage, but nevertheless broadly heading in the right direction. At the same time, the green line, which represents the services sector, growth has always been above trend being 50, and so held up by the consumer essentially has been doing very well, but even there we're starting to see a slowdown. The way I would read the global economy is that it's likely to muddle through at something like a trend rate, maybe slightly below. So moderating inflation and reasonable but quite modest growth. If we look now at the US in particular, and we bring up this chart of US recession watch. So we monitor a whole range of different economic and market indicators that might give us some clue as to the extent of any recession risk in the US economy. The red line represents the levels of each of those series that has been associated with recession in the past. The blue line represents the last value, the last observed value for each of those variables, and the green line shows you where it was for each of those a year ago. The key point for you to take away here is we're looking for any signs that any of these indicators are within that red circle, meaning they're consistent with recession. And the only ones that really stand out for us remain yield curves, which you'll see on the right-hand side of that chart, where the green and the blue line, in fact, the most recent, are within the recession zone. And possibly the only other areas is consumer sentiment expectations and small business confidence, both of which are quite low and consistent with recession. But if you go outside that and you look at what economists will call hard data, that is, rather than survey data or financial market data, what is actually being produced, what's the actual output, most of those are well outside recession territory. To be fair, they have weakened. That is, the blue line has come in below the green line, meaning it's weaker than a year ago, but they're still well above recessionary levels. One of the areas of interest in the US is the consumer. Now, I mentioned before that the service sector has stayed pretty strong, and one of the reasons for that has been that consumers have carried excess savings from COVID and fiscal handouts over that period. But what we're now seeing is that those savings have largely been exhausted. They did top about 2.2 trillion in 2021. They're now almost exhausted, as I said before. So the US consumer now doesn't have this buffer to rely on. US elections, of course, is a key focus now. And as we've seen over the past couple of weeks, this continues. There's lots of volatility and lots of change. And in fact, we can now strike Biden off the Democrat ticket on the left-hand side. And we don't know yet who that candidate will be, and we'll find out over the coming weeks and months. Nevertheless, the contrast is probably going to be very similar. And on the left-hand side, for each of those policy points in the middle, we show what a Democrat candidate is likely to bring. And we can also see what a Trump presidency would bring in respect to each of those policy areas. So domestic policy, let's just focus on the Trump. Trump is favoured at this stage to win the presidency in November. So we're going to focus mainly on some of the policies there. Reshoring, job creation, less immigration, less regulation more generally, and ESG is likely to favour certain sectors, potentially finance and energy sectors, or old energy sectors in particular. On the tax front, Trump is keen on extending the tax cuts and perhaps even broadening them out, whereas the Democrat side is probably more focused on ending those tax cuts as they were granted a number of years ago. With regards to tariffs, both parties have extended tariffs, particularly with respect to China. The Trump policy seems to be to broaden that out to other countries, not quite to the level imposed on China, but nevertheless to broaden out tariffs. On the fiscal side, the Trump presidency seems to be more focused on lowering tax, but possibly reducing spending in certain areas. Whereas on the Democrat side, it's probably more of a focus on increased government spending and higher corporate taxes. Monetary policy is interesting. There's some fear that a Trump presidency, if not now, then down the track, perhaps there might be pressure on the Fed's independence, and in particular, or more specifically, that Jerome Powell could be replaced. He's recently repudiated that comment. But it could well mean that there's a higher neutral cash rate in the offer based on higher or greater fiscal spending and higher inflation. On the inflation front, under a Trump presidency, we're likely to see higher inflation, partially due to tariffs and reshoring, also less immigration, which puts pressure on labour markets and reshoring. So some of these factors are also in play under the Democrat candidacy. And then geopolitics is, of course, a major area, and we've only recently seen comments coming from Trump about Taiwan getting support from the US, and also in regards to the Ukraine. So when we focus on the impact of a potential Trump victory in November, we can say tax cuts looks to be on the agenda, less regulation. It tends to boost the supply side, tends to boost growth. So it could be viewed as a positive for growth, and perhaps the market is running with that at the moment. However, we could also talk about the impact of higher tariffs, lower labour force growth, reshoring, adding to inflationary pressures. Both parties, and particularly Trump, under that new administration, budget deficits are likely to remain high, and the Fed could well be challenged over the coming 4 years. So the market impact in 2024 and 2025 is partly dependent on where the policy focus is likely to be. Is it on tax cuts and less regulation, which is positive potentially for markets, or is it going to be initially on more restrictions, less immigration, higher tariffs, which in fact could be more inflationary? Closer to home now, we want to just focus in on the RBA, and we showed that chart earlier on about inflation going forward. It's been coming down in pretty much all economies, with the exception of Australia more recently. So if we look at how markets have changed their expectations of what the RBA is likely to do, at the start of the year, the blue bars suggest that the market was pricing in about 83 basis points of easing over the course of 12 to 18 months. By July 18, the green bars, that had changed to about 42 basis points of easing happening later. And then, of course, the orange bars were showing what the most recent expectations around rates were, which was basically a 40% chance of a tightening, in fact, and less easing going forward. So expectations have continued to change over a period of time. So what does that mean for the domestic economy and indeed domestic equity markets? So this is interesting. It looks at the growth inflation trade-off over the past almost 3 years, in fact. So back in June 21, we had a situation where activity was strong, that's the NAB forward orders, and inflation was low. By 2022, that had changed to activity strong, inflation high. By 2023-24, we'd moved into the top left quadrant, which was weak activity, but inflation still too high. And this is problematic because it does not allow the RBA to respond to lower growth. Until such time as that green arrow starts to turn downward, and into that bottom left quadrant, the RBA is going to feel the pressure to possibly tighten, but certainly would be an impediment to easing. And that is always problematic for the equity market. And it's one of the reasons why the Australian equity market has tended to lag global markets. So where are we positioned at the moment? What sort of decisions have we been making? So I'll just highlight a few of the areas. We have added to duration, that's the second line, from an underweight position to close to neutral, still slightly underweight. As I mentioned earlier on, we're not expecting a big bond market rally or a recession at this stage. So we've lifted duration, but only back to a modest underweight position. The other change has been to, first mentioned Australia. We've gone from an overweight Australian equity position to a slightly underweight position, and at the same time we'd increased US from an underweight to a neutral. The reasons on that Australian decision I already mentioned. Growth is lower, earnings growth is a bit weaker, and the central bank, the RBA, is not in a position to actually ease anytime soon. And then finally, just to reiterate from a style and factor point of view, we have an overweight to global small cap, an overweight to quality. They're probably the two key factor or style positions that we have in the portfolios at the present time. So just to sum up, we're positioned for soft landing, but we are very mindful of valuations starting to become extended. Disinflation will continue, although less swift than over 2023. And so our portfolios are positioned to show a preference for global over domestic equities. They have been positioned to take advantage of higher bond yields and to be overweight investment grade or higher quality credit. And we're also looking to capture the rebound in global small caps as markets rotate to cheaper sectors as interest rates come off. And we still provide a decent exposure to quality companies.